Combining candlestick analysis with support and resistance levels creates a more practical approach to technical analysis because it allows traders to study both the location of price and the behavior of buyers and sellers at important market areas. Support and resistance levels identify zones where price has previously shown a tendency to reverse, pause, or consolidate, while candlestick patterns provide additional information about the strength of buying or selling pressure around those zones. Instead of treating a candlestick pattern as an independent trading signal, traders can improve their analysis by waiting for that pattern to appear near a meaningful support or resistance level. For example, if price approaches a well-established support zone and forms a bullish engulfing candle, hammer, or strong rejection candle, it may indicate that buyers are defending the area and that a potential upward movement could develop. Similarly, when price reaches a resistance level and produces a bearish engulfing candle, shooting star, or another strong rejection pattern, it can suggest that sellers are becoming active and that the upward movement may weaken. The strength of these signals depends heavily on the quality of the support or resistance level. A level that has been tested several times without being broken may be more significant than a level created by a single price reaction. Traders should therefore begin their analysis by identifying major support and resistance zones on higher time frames before examining candlestick formations on lower time frames. It is also important to understand that support and resistance are usually zones rather than exact prices, because markets can temporarily move above or below a level before reversing. When a candlestick pattern forms within such a zone, traders can examine its size, wick structure, closing position, and relationship with previous candles to determine whether the rejection appears convincing. Confirmation can also come from increased trading volume, trend direction, or momentum indicators, although no single indicator can guarantee a successful trade. Risk management remains essential when combining these techniques. A trader should define an entry point, stop-loss level, and profit target before opening a position rather than making decisions emotionally after entering the market. For a bullish setup near support, the stop-loss may be placed below the support zone, while the target can be positioned near the next resistance area. For a bearish setup near resistance, the stop-loss may be placed above the resistance zone and the target near the next support area. This approach helps traders establish a clear risk-reward relationship and avoid entering trades simply because a candlestick pattern looks attractive. Another useful technique is to wait for confirmation after the initial candlestick signal. For instance, a hammer at support may indicate rejection, but traders may wait for the following candle to move above the hammer's high before considering an entry. Similarly, a bearish rejection candle at resistance can become more meaningful if the next candle confirms downward momentum. Overall, combining candlestick analysis with support and resistance levels helps traders move from pattern recognition toward contextual decision-making. The objective is not to predict every market movement, but to identify situations where price location, candlestick behavior, and market structure provide a stronger confluence of evidence. Traders should practice these setups on historical charts and demo accounts before applying them with real money, because market conditions can change quickly and technical signals can fail.